First of all, hi everyone. Hope everyone's doing well. And firstly, welcome and thanks everybody for joining today's session. Um, Given that we've um, got all of the shops and the zoos and safari parks back open, I think you all deserve a special pat on the back for attending a session so snappily titled as Government Incentives for Smaller, Fast-Growing Businesses. Um, by way of introductions, I'm Andrew Neely. I'm a senior manager in the reward and employment team at PwC Manchester. And I specialise in the design and the implementation of management incentive schemes and employee share schemes for a whole range of companies, right up from listed companies right down to very small private startup. Joined by James Geldart, director in our innovation incentives team, and Matt Smith, a manager in that team, who both specialise in R&D tax credits, and by Emma Riley in our private business team, whose work includes advising companies in relation to EIS investments. The reason why we've brought these topics together today is really because when we've been working with smaller, fast-growing private businesses recently, we found that the same key issues that are facing them are often very much the same. And these include a need to preserve cash flow and manage cash flow, to ensure that they can recruit and retain the best employees in their particular market, and to encourage investors and investment in their particular businesses. Whilst the incentives that we're going to talk about today have in many cases been around for quite some time, we thought it'd be important to bring them together, in particular as often the requirements and the conditions overlap in the same way as the issues that they're designed to solve. I should say this is very much designed to be an introduction to each of these matters, and it's designed really to quickly, hopefully, enable you to see if there's something that's applicable to your business, and if so, how it might be applied. Given the format and the amount that we've got to get through, we don't propose to sort of take questions as we go along. But if you have got questions, please add them to the chat, and we'll try our best to deal with them at the end. Alternatively, if you've got anything sort of specific to your business, more than happy if you want to email us or give us a call afterwards, and our details are on the screen there. In terms of running order, we're going to start with James and Matt on R&D tax credits. I'm then going to be covering EMI, and Emma's finally going to be taking us through EIS. So over to James and Matt in relation to R&D to kick us off.
Great, thank you, Andrew. Brilliant. Okay, so just in terms of introduction, so my name is James Geldart, as Andrew kindly pointed out, and I'm a director within our innovation incentives team, which is made up of R&D, Patent Box, and capital allowance specialists as well. And we're sort of a 120 strong team nationally of dedicated specialists in this particular area. And just to give a little bit of background before we run through the next couple of slides, I mean, even though R&D tax credits is nothing new, focus on those specifically first. Been around since 2000, 2001, since the inception of the regime. I'm shocked at how many companies we constantly come across who are either not making claims that are eligible or are certainly not maximising the claims that they can make, and that's without any substantial changes in terms of the qualification criteria per the legislation itself in almost 20 years. So and so the majority of the clients we work with, they're already making claims but don't quite understand just the breadth of that criteria. So the first slide is just a little bit of a reminder on the benefits that are available, because that is something that's changed. So even though the basic criteria has not, the benefit keeps going up. And really that's a great indication of the amount of government support that we have behind R&D tax credits, and that they see it as a fantastic mechanism to encourage innovation in the UK. And that government push is quite important, because I think another thing that we see a lot from our clients is a nervousness. So this is tax. This is tax. Tax savings, tax credits. And if we don't have information or data we can hang our hat on, then we shouldn't be making claims. And actually, the government push and support behind R&D tax credits has meant that HMRC are a lot more practical within this area than they might be within other areas of tax. So I think that's quite an important thing to bear in mind. And although it's important to have a sensible and a HMRC approved, if you like, claim methodology, there is areas where you can be much more pragmatic than you might be within other areas of tax. So I think that again changes the landscape a little bit. And as long as the government keep applying that level of support, I don't expect things to change there. And we did have a little bit of a scare with some of the comments Jeremy Corbyn was making around R&D tax credits and so on. Prior to that, we've always had cross-party support, and I think some of the more recent comments we've heard from Keir Starmer have been much more positive in terms of Labour's backing for this regime. So it's one that looks like it's going to continue for some time to come, which is obviously very good for everyone. So just in terms of a few of the highlights, and again, many of you I'm sure will be aware of them, but the R&D regime, there's two different R&D regimes, one for SMEs, which is a enhanced credit that can be traded in for cash. So you're looking at really to cut down to the benefits of these between 25 and 33% back on your qualifying R&D costs, which Matt will cover a little bit later on. And that's a saving that runs through the tax line. The large company regime, which is for groups that have more than 500 employees, and there's other turnover and balance sheet metrics, which I won't go into now. That's normally the key one, the number of employees. There's a different regime, the large company regime, if you like. And that regime works slightly differently, both in terms of where it sits from a benefit perspective, but both in terms of the amount as well. So that is a 12%, actually going up to, or has gone up to 13% from the 1st of April 2020, taxable credit. And that's accounted for in the same way as a government grant. So you're able to actually set that against cost in your accounts, enhancing EBITDA. So mechanically, they work quite differently, and the benefit levels are quite different as well. But both two of the most generous regimes in terms of tax incentive regimes out there at the moment. The two not to forget, which often are forgotten, are the patent box regime and also research and development capital allowances. So this is something that we're constantly hearing from government, and we're constantly in conversation with policy around these regimes, is underclaims in the area of patent box and in the areas of RDAs as well. So RDAs are a capital allowance, effectively an accelerated 100% allowance in the year of expenditure for any equipment that's used for research and development. And there's a proportionality to look at there depending on use, but it's something we often see not looked at all. And the other one is the patent box regime, which is a 10% tax rate on profits derived from patented technologies. And I think the important point there really is that a lot of the clients that we're discussing this with, they don't have patents at the moment. They've never really looked at it or thought about it. What we tend to find in the UK is it's not forefront of mind like it is in the US, for example. And it's certainly an area we're encouraging all of our clients to look at a little bit more closely. Could you get a patent on the resultant of your R&D work? And therefore, could you be eligible for a longer term benefit for the innovation that you've invested in? So that's one certainly to keep on the radar. And as Andrew said at the start, more than happy if people have specific questions or want to pick up offline on that particular area, because we see minimal claims, patent box claims, huge area of potential. Matt, do you just want to flick on to the next slide?
Yep.
Thank you. So I'm just going to cover the first half of this slide and let Matt talk about the next slide. And it's fairly basic, really, the top half of this. It's the bog standard, if you like, HMRC definition of qualifying research and development. And we put this up quite a lot because it just shows the breadth, really, more than anything else. And I think that half the problem with the R&D credit regimes is the term R&D. And often when we go through this definition with many of the companies that we speak to, there's an appreciation that actually this is much broader than what we might consider to be R&D. Really, this is aimed at broader innovation when you go through that definition. And a lot of the companies that we speak to get stuck at the top two, if you like, bullet points there in terms of technical advance and technical uncertainty, which is there has to be an extent in overall knowledge or capability in a field of science or technology. And we sort of get stuck there. And actually, most of the claims that go into HMRC are not within that bullet point. They're within the second two more often than not, which is I'm creating a process or a product which increases overall knowledge or capability. So it might be using existing science or technologies, but it's the way that's bolted together and the way that operates, which means you've got a product or process that would be considered an overall advance, and also appreciable improvements to existing processes and products as well. And this is all in relation to a competent professional working in that area. So that will be the technical professionals that you have within your organization, as to whether they would consider these to be appreciable improvements. So it's a much broader definition, and often the best place to start with this is, well, what am I doing that's new and different, where I can't very easily go out there into the broader industry and find the answer. Chances are you may well be doing something that meets that first definition. So it is incredibly broad. And similar with technical uncertainty, the top category, if you like, is uncertainty exists as to whether that advance is feasible. And again, we often find companies get stuck there. And again, most of the claims you see going into HMRC are covered within the second 2 bullet points, which are, I know I'm going to get there, but I don't know how I'm going to get there. So I'm looking at a particular product or a particular process. I know I will get some level of improvement, or I know I will meet the standards that have been set for this new product, but I don't quite know how at the moment. And trial and iteration and so on, and learnings that have come through that are very good indicators that you've been doing things that will meet that second criteria as well. And the other one not to forget about, which is the final bullet point there, which is particularly prevalent with software related claims, is an overall system uncertainty. So you've got a number of aspects which are proven, maybe for different uses, maybe in different combinations. You bring all of those together to try and build your system or product. And there's some challenges there as to how that will work together and how it will work together in the environment in which you need it to. And again, that would constitute technical uncertainty as well. And it's still surprising, even 20 years on, how often we're having this conversation with clients, and the technical professionals that we're speaking to are just not aware how broad that is. And sometimes it's useful to go back to the whole purpose of the R&D regime, which is the employment of technical individuals here within the UK. That's the main driver. It's an employment agenda rather than a profit agenda. That's sort of a nice side benefit to things. And really, if you are a company that's employing technical experts, technical individuals, this regime is designed for you. And I think for those technical professionals, it's sometimes hard to get away from what they consider to be their day job. Okay, I'm an engineer working in a specific sector. Well, everything I do is uncertain, and everything I do involves doing something different. So surely I'm not meeting the benchmark for this. And the answer to that often is, well, you probably are. So I think what the takeaway really from this is just having a particularly broad mindset when it comes to what you do and whether it might meet this criteria, and having a conversation about it really. But I'll hand over to Matt just to go through the qualifying cost categories and maybe some of the main things that we see there, again, that companies are not necessarily aware of in terms of scope and of the available credits. And then, as Andrew said, we can maybe take some questions at the end.
Brilliant, thank you. So when it comes to sort of quantifying your R&D claims, as James was saying before, we often see specific areas being underclaimed or in some instances being entirely missed. So if we start with staff costs often form the largest proportion of R&D claims. And although people sort of assume that you need quite granular detail in terms of timesheets and everything to substantiate R&D claims, HMRC have got far more pragmatic in this respect in recent years. And as a result, it's not unusual to essentially assign sort of percentages to each individual to the nearest maybe 5%, as long as you feel that fairly represents their R&D effort. That isn't an unusual claim methodology at all when it comes to staff costs, and it's far less time consuming to collate. With staff costs also we often see qualifying indirect activities being missed from claims, and so the definition of indirect activities is quite broad, and we find that there's often a sort of level of fear almost in claiming those types of costs, but the actual guidance specifically states which form of indirect activities you can include, and that extends to things like finance, time, if they're, for example, setting budgets for R&D or paying sort of the salaries or for R&D individuals, and also the time spent hiring R&D individuals is time that is eligible for inclusion in claims. So moving on to a couple of the other cost categories, another area is sort of third-party costs, and that's covered by the externally provided workers and subcontracted R&D boxes on the slide. So if you engage under the SME regime, if you engage any third parties to support you with R&D, you can claim up to 65% of those costs, to the extent that they have supported on actual qualifying R&D activities. The 35% that's stripped out is essentially sort of a assumed profit margin of the third parties. So it's essentially intended to get you back to the staff costs of those third parties which are eligible. The other area on this slide which I'd like to draw sort of specific attention to is consumables. So people will often capture things like materials that are used up or transformed as part of the R&D regime, but we often see software licenses being missed, and also utilities. And again, they're eligible cost categories that can be captured, and HMRC are relatively pragmatic at sort of how you determine the qualifying proportion of those costs. And then finally on this slide, just wanted to draw specific attention to the bottom right-hand corner, which is grants and subsidies. So there's often an assumption if your R&D is funded by grants or even customer funded, you can't make an R&D claim. And although you can't make an R&D claim under the SME regime, you can still claim under the large company RDEC regime that James sort of outlined the benefits of earlier on. So it's one to keep in mind if you are getting any sort of funding for your R&D. I wouldn't automatically sort of dismiss that from your R&D claim. And then, although this isn't relating specifically to R&D, we wanted to quickly cover the Future Fund. So this is government funding that's been created in response to COVID. So they've essentially created the Future Fund, and they've made £250 million available, which is to be distributed through convertible loans to qualifying entities. This funding can vary between 125,000 and 5 million. And also it's worth mentioning there, which isn't on the slide, that the Future Fund can essentially match up to 100% of the amount provided by investors up to that £5 million cap. And the Future Fund is currently open for applications, and that, as things stand, although it is being sort of constantly reviewed, that is open until the end of September. So in terms of who's eligible to claim for Future Fund funding, you essentially need to be a UK incorporated company that's raised at least £250,000 in equity investment from third parties. In addition, none of its shares can be traded, and either at least half or more employees need to be UK based, or at least half of your revenues need to be from UK sales. And then finally, in terms of the application process, I don't propose sort of deliberating on this for too long, but it's worth noting that it's a investor-led process. So the investor or the lead investor of a group of investors make the application in connection with the company. And then just the final point on there, which is worth highlighting, is that for successful applications, funds will be distributed through a nominated company solicitor, and it's that company's responsibility to essentially appoint this solicitor. Yeah, that's a very high level overview of the Future Fund, but again, we're happy to answer questions at the end if you have any.
Yeah. Thank you I'm echoing a little bit there. I think sort of the key message is, there's still a lot of government support behind and for innovation. So it's definitely worth exploring these new initiatives that have come more recently, but also certainly revisiting the existing initiatives that have been around for some time, just to make sure you are making the most of it. And we're quite lucky at PwC because we are a team of both accountants and tax experts, but we also have almost 50% of our team are technical backgrounds, be it software developers, engineers, chemists, and so on. So certainly in terms of understanding what you're doing and ensuring that you are really at the lines of what's available, we can help with that.
Right, so back to me, and thanks very much, James and Matt, for that. That was really useful. So next on to EMI. But before that, I think one of the most important things for companies to do before they look to set up an incentive scheme or an EMI scheme in particular is to look more widely at their company strategy and to think about what they're actually looking for their incentives to do and what they're looking to incentivize their employees towards. I think it's only really when they figured out that and that link with sort of company strategy and shareholder aims that it's right to sort of jump into the very specifics of the scheme and which particular scheme you should look to set up. And that's why I think this slide's really useful, just in terms of sort of setting the scene and how the reward package can really vary depending on different types of businesses, depending on where they are in their maturity and their particular circumstances. And therefore, I think for, in the context of this talk where we're talking about smaller, fast-growing companies, we're really looking at those reward models in the top right and the bottom left of the screen. And these are businesses that are looking to grow aggressively in the short to medium term, often with a view to maximising value in preparation for an IPO or a sale. And in terms of reward structure, what does that mean? Well, that effectively means a relatively low base salary, a medium to higher annual bonus potential, but then with a particularly high potential equity incentive, which is frequently linked to those sort of exit strategies. So moving on to the next slide, and how does an EMI scheme fit in with that? Well, the answer's pretty perfectly, and ideally, really. Essentially, an EMI scheme is an employee option scheme whereby employees are granted a right to acquire shares at a point in the future at a predetermined exercise price. And that point or that exercise date is typically tied to an exit of the company, at which point the employee is able to exercise their option, acquire the shares, and then sell the resulting shares either to a buyer or in the market. And the main benefit in relation to EMI is from a tax perspective, because unlike if you were to pay a cash bonus to employees where they'd be subject to income tax at 45%, employees national insurance at 2%, employers national insurance at 13.8%. The gain made by an employee in relation to an EMI scheme is potentially subject to 10% capital gains tax rate, which will apply if those conditions are, if the necessary conditions are met. So moving on, sort of EMI schemes are very flexible, so any number of employees can be granted options, with different numbers of shares being granted under options to different employees. So what are the qualifying requirements that you need to think about in terms of being able to be eligible? Well, firstly, the company can't be under the control of another company. So if you've received external investment and that investor holds more than 50% of the voting rights, or it's able to control the board, then the company won't qualify. Secondly, the company and its subsidiaries can't employ more than 250 employees. Thirdly, the company and subsidiaries can't have gross assets of more than 30 million. And finally, the fourth main requirement is that the company can't carry out certain excluded activities. And these include things like property development, providing legal or accounting services, operating or managing hotels, operating nursing homes or care homes, or carrying out banking or insurance activities. Of course, if anyone's unsure about any of these and whether they'll apply to you, please just let us know and we can circulate a full list. The other main point to note is in terms of eligibility in relation to employees. So only employees that work at least 25 hours per week or 75% of their working time are eligible to be granted EMI options. Finally, it's worth noting the two main limits. So firstly, EMI options can only be granted over shares with an upfront value of £3 million in aggregate, and no one employee can be granted EMI options over shares with an upfront value in excess of £250,000. It should be noted that all of these limits are calculated on the date of grant. So if, for instance, the gain made by the employee on an exit is significantly more, then these limits won't be breached. The next slide, just moving on, really sort of just sets out in numerical terms what that sort of tax differential looks like, comparing an employee who makes a gain in relation to an EMI option and those who are simply paid a cash bonus or a granted unapproved option. So as you can see, where you've got an employee who receives a gain of £140,000 under an EMI scheme, they'll pay just £14,000 in capital gains tax, leaving the employee with £126,000 in their pocket. By contrast, if the same employees were to receive £140,000 under a non-tax advantaged option or be paid a cash bonus of £140,000, then they'd be subject to income tax and employees' national insurance, along with employers' national insurance also arising. And assuming that employees taxed at the additional rate, they'd be left with just over £74,000, so almost £50,000 worse off than the person who's granted the EMI option. Just moving on to the next slide, and this covers the steps to establish an EMI scheme. So these include firstly sort of an advance assurance, whereby what a company is able to do is write to HMRC with the background information in relation to the company and seek HMRC's confirmation that it agrees that the company qualifies to grant EMI options. It's also possible to agree the valuation of the shares over which the EMI option is being granted. And we'd usually recommend doing this as it provides certainty in terms of the tax position, and also on a future exit when a buyer might do their due diligence, it's often one of the things that's requested. Thirdly comes the legal documentation. So an EMI scheme's usually governed by what's called a set of plan rules, which sets out the main terms in relation to the scheme, such as who can be granted options, what happens when they leave, and when they can exercise their options. And then there'll be specific option agreements for each option holder, setting out the terms specific to them. So, for instance, the number of shares under option, the exercise price, any performance conditions applicable to that particular option holder. And then finally, in order to qualify for EMI, it's important that the grant of the options notified to HMRC online via the company's PAYE portal. If we move on to the next slide, this is just a bit of a brief plug for our tech-enabled EMI offering, which we've developed, whereby what we've looked to do and essentially done is try to streamline a lot of the process in terms of setting up an EMI scheme by automating the production of the documentation that we mentioned before. So essentially what this means is that once you build out an online question, with a few clicks of buttons, we can deliver the full suite of EMI documentation within 24 hours. And really this is just basically cut down what can be weeks and or months in terms of getting the right information together, documentation together, and to try and make the process as easy and efficient as possible for everyone. Finally, the next slide and the next question that often arises is, what can a company do if they don't qualify for EMI, and what other alternatives might be available? Well, this might be because the employees exceed the 250 employee limit, because it's got gross assets of more than 30 million, it's under the control of another company, or it engages in one of those excluded activities. Well, there's lots of other schemes that might be appropriate and available depending on those circumstances and what you're looking to achieve. But these include, firstly, as you can see, a CSOP. So that's a HMRC tax advantaged option scheme. It's similar to an EMI scheme, but the maximum value of shares that can be granted under options, £30,000. Like EMI, they're quite flexible and relatively easy to establish, and you can select your participants and the size of their awards at your discretion. And it's also possible in relation to a CSOP to agree the value of the company's shares up front with HMRC. The next alternative would be potentially a growth share arrangement, and what you do there is you create a special class of shares in the company, and those shares are only entitled to part of the sale proceeds on an exit above a specified threshold or hurdle. And generally, provided you set that hurdle at a sufficiently high level, generally the upfront value of those growth shares that the employees will acquire should be relatively low. I should note that a growth share and what comes next, a JSOP, are slightly different from an EMI scheme or a CSOP, because they involve the employee acquiring the shares up front, i.e. on day one, rather than acquiring or being granted an option over shares whereby they actually acquire the shares at a future date. Thirdly, if you don't want to change your articles for any reason, for instance, due to you might have shareholders that don't want to change the terms, and then you might want to look to set up a JSOP. So a JSOP is similar to a growth share scheme, whereby the employee will only receive an amount on an exit above a predetermined hurdle or target. But in the case of a JSOP, rather than the employee acquiring a special class of share, they'll acquire an interest in part of a share that's split with a trust. Finally, if all else fails, so to speak, you might wish to look to simply establish a phantom scheme, and that essentially just allows employees to receive a cash amount on an exit by reference to the value of the company, or a relatively simple unapproved option scheme whereby employees are granted options over shares, both of which can be established quite quickly and easily. However, the downside being that unlike a growth share scheme, a CSOP, or a JSOP, payments under a phantom scheme would be subject to income tax and national insurance, rather than having that more favourable CGT tax rate. So now you're all experts on EMI and management equity. Over to Emma to EIS.
Thanks, Andy. Hi everyone, I'm Emma Riley. I'm a senior manager in our Northern Private Client Private Business team based out of Newcastle, and I get involved advising businesses and the individuals behind them as they go through their business life cycle. And I'm going to finish off today's presentation just covering off an overview of one of the most generous tax reliefs out there, and a really valuable scheme for newer businesses, particularly the Enterprise Investment Scheme, or EIS. So EIS is one of 4 key venture capital schemes. These schemes are designed to encourage investment in newer, smaller unquoted trading companies, and they provide various tax reliefs to individuals who invest directly or indirectly in qualifying small, higher risk companies or social enterprises. The 4 main schemes I'll cover them off briefly. The Enterprise Investment Scheme, EIS, which encourages direct investment by individuals. The Seed Enterprise Investment Scheme, SEIS, which is a baby brother of EIS and is specifically for really early stage small companies. Venture capital trusts, these encourage indirect investment through a corporate vehicle similar to an investment trust. And the Social Investment Tax Relief Scheme, which provides relief similar to EIS, but for investments in social enterprises. So today I'm going to focus on EIS, but it's worth pointing out that many of the qualifying criteria that I'll cover off are very similar for all of the schemes, albeit with differing relief available from a tax perspective. Given how generous the reliefs are, they're particularly attractive to high net worth individuals, business angels and entrepreneurs looking to start up a new company. Although bearing in mind there is a degree of commercial risk usually with the EIS investments, and the rules are actually designed to preclude any degree of protection for the investor. It is a risk investment. As you'd expect with generous tax relief, there are also lots of hoops to jump through, both to firstly get the relief in the first place, and then also to maintain that relief. And the devil really is in the detail with EIS. Just for a bit of background and for interest, EIS has been around since 1993-94, but picking up on something that James said, there's a surprisingly low number of EIS claims that have been made since then. Only 30,000 companies just over 30,000 have got EIS status since that time. HMRC have just released the statistics at the end of May for the 2018-19 tax year, which show that just under 4,000 companies took advantage of the EIS scheme, primarily coming from 4 sectors: information and communication, professional, scientific and technical, manufacturing, and wholesale and retail trade. Final general point around the EIS is that the EIS and other VCT schemes are approved state aid schemes, which might need to be taken into account or borne in mind if your company is applying for other state aid type grants. Next slide, thanks, Matt. So the tax reliefs, why is EIS such a good thing, and why would individuals want to invest in an EIS qualifying company? Well, firstly, there's an upfront tax relief on their investment into the EIS qualifying company by way of a 30% tax credit, which reduces their overall tax liability. This is on up to £1 million of EIS investment per annum, so a maximum of 300k of tax relief a year. And that income tax credit can be used in the year that you make the investment, but it can also be carried back to the prior year quite flexibly, up to the limits allowed for that year. Secondly, a holy grail from a tax perspective, where income tax relief has been claimed and required conditions met, you can actually achieve a total tax-free disposal of your EIS shares themselves with no cap on the gain that you might have made. So really, really good relief there. Thirdly, there's also an ability to defer other capital gains that you might have incurred on other assets on a pound-for-pound basis against your EIS investment, and that gain is deferred up to the disposal of those EIS shares. It's worth pointing out, though, and people can get caught out on this, that it is just a deferral, and that gain will pop back into charge at the point that you dispose of the EIS shares. And also that gain that pops back out is charged at the prevailing capital gains tax rate at the time, rather than the rate at which you deferred it, i.e. it could have gone up, and you are taking a bit of a punt on that one. 2 additional benefits for EIS shares to mention. Any losses on the disposal of the shares can be offset against income as opposed to gains. And finally, if you hold those shares for the 2-year qualifying period for business property relief, you can potentially get 100% exemption for inheritance tax purposes. So it's also a really good investment from an IHT perspective. Some key timing points to think about with EIS. To qualify for the CGT exemption and the income tax relief, you have to have those shares for 3 years from the date of issue, and there's lots of qualifying conditions which I'll cover in brief in a minute that need to be met throughout that 3-year period. If there is any breach of those conditions, the income tax relief is withdrawn, and you might end up having to make a repayment to HMRC, and you won't qualify for that nice tax-free disposal. For the deferral relief, the EIS shares have to be issued between 1 year before and 3 years after the date of the gain that you're wanting to defer. Next slide, please. Thanks, Matt. So, what are the qualifying criteria? There's a lot. So there's conditions that need to be met for the company, the investor, the investment, and there's also some overarching conditions. So starting with the business itself, we're looking at unquoted trading companies. Most trades do qualify with some notable exceptions, which sort of follow the same as Andy outlined with the EMI. So any sort of asset-backed businesses dealing in land, hotels, care homes won't qualify. Dealing in commodities or shares or financial activities such as bank, insurance or legal won't qualify. Neither will property development. Preparing to carry on a trade as well as actually trading can qualify, and also shares in the parent company can qualify for EIS as long as your trade is being carried on by that company or a 90% qualifying subsidiary. Similar to EMI, all your subsidiaries have to be qualifying, so they have to be 51% subsidiaries. And at the point that the EIS investment goes in, the company's gross assets have to be less than 15 million, and the company has to have less than 250 employees. Finally, it also has to have a permanent establishment in the UK. Moving on to the investor, the overriding rules for EIS is that the investor can't exceed a certain level of connection with the company, and you're connected. The time frame for the connection is any point beginning 2 years before you issue your shares and 3 years after. If you're an employee or a director, and there are some exceptions to that which I'll come on to, or you own more than 30% of the ordinary share cap of the company. It did used to involve, the definition used to include loan capital as well, but that's been removed now, and what we're looking at really is 30% of ordinary share cap, voting rights and assets on winding up. There's also a relatively new criteria for individuals. It's called independent investor, whereby you must not have any other shares in the issuing company when you apply for your EIS shares, unless they are also EIS shares. So one question we see a lot from individuals looking at EIS in companies is, and they ask is, can I be a director? Understandably, they probably do want to be a director. And on first principles, they are connected under the EIS rules, but there are some exceptions. So it is possible to structure it such that you can be a director. So firstly, you're only connected as a director if you receive payments other than reasonable expenses. You can also receive fees for services that aren't director services. So for example, if you were providing consulting services to the company. You can also qualify as a business angel. And to be a business angel, your only connection has to be that you're a paid director. So you can't fail that 30% test. But also, you can't have been involved in the running of the company before the issue of the shares. Now, the shares themselves also have criteria to meet to be qualifying for EIS. They have to be unquoted. Companies on AIM is classed as unquoted for this purpose, and there can't be any arrangements for a future listing. And they must be new ordinary shares, and quite vitally, they have to be fully paid up in cash at the point of investment. So I have seen companies getting into a bit of bother where they've, for whatever reason, issued shares but haven't taken payment. And you also see sometimes where individuals have made payments to companies, but they haven't actually received the shares. Now, in those circumstances, HMRC will sometimes accept advanced subscriptions within certain parameters, but it's worth sort of taking advice on that point. The key point about the shares really is that they have to be the poorest ranking shares amongst all the share classes. They can carry no preferential rights to dividends or to companies' assets on winding up. And there can't be any arrangements in place for pre-arranged exits. As I sort of outlined with the qualifying trade, the monies that the company receives must be used in one of these qualifying business activities. The funds can't be used to acquire an existing business. What the revenue are looking for and what the rules are seeking to ensure is that the money is used for organic growth and development in the investee company. And a couple of final rules. The total amount of risk finance assessments a company can receive, so this includes EIS, CDIS, VCT, in its entire lifetime is limited to £12 million. It's slightly higher if it's classed as a knowledge-intensive company. And likewise, it has to have received its first EIS investment no later than 7 years after its first commercial sale. Again, there's a slightly longer time frame for knowledge investment companies. In the final box on the slide there, I've put as a separate point to the risk to capital rules. Now, these are quite new rules. They only came in 2018, and the revenue have introduced them almost as a gateway to the schemes overall. And they're looking for this condition to be sort of met before it'll even consider the other rules. And effectively what this is, there's two parts. First, the company in which the investment is made has to have objectives to grow and develop over the long term. And what the revenue are looking for and what they ask for in your application when you apply is there a business plan? What are the financial forecasts for the funds that are being sought? They're looking for things like increasing revenues over time, increasing number of employees. Is this company using the funds to grow? Secondly, from an investor's perspective, this condition requires that the investment has to carry significant risk and that the investor could potentially lose more capital than they gain as a return. And the revenue are really trying to stop any sort of capital protection mechanisms put in place on investments here. Again, it has to be a genuinely risky investment. Next slide, thanks, Matt. In terms of getting into EIS, what are the practicalities around applying and getting there? So similar to EMI, I've put that there in the first box, the advance assurance. Now this isn't necessary, but it is useful, and we would advise our clients to take an advance assurance. It provides more certainty around your application. You outline what the proposed transaction is, what your business structure is, and the activities you'll be doing, and the revenue will say whether they think it would qualify for EIS or not. It's worth pointing out on these that they can't be speculative applications. The HMRC are expecting to see some names of likely investors. They expect you to be sort of partway through the process of thinking about this properly, and you can't sort of not include in those names. They also won't comment on whether specific individuals will qualify, because those individuals would have to meet criteria themselves, but vitally they will say, we think your company will qualify. And the good thing about the advance assurance too is that when you come to do the EIS1, the actual application, if you've received advance assurance from HMRC, all they'll ask for is any updates that have occurred to the company or the transaction from the details that you included in the advance assurance. So it's a less arduous process. So once you have issued your EIS shares, you apply to HMRC with the EIS1 application. Assuming they grant EIS status, they will issue your company with an EIS2 certificate, which says that it's an EIS qualifying company. And they'll also provide the company with these EIS3s. Now, the EIS3s are the certificates that the individual investors will require to complete their self-assessment tax returns and to enable them to use the relief. From a company perspective, a couple of things to think about going forward. The use of funds. So you have to have invested 100% of your money within 2 years. We would advise companies with EIS funds to probably put them in a separate bank account. This means that it's quite easy to track how those funds have been employed in that 2-year period. And if HMRC asks to see and to check that it's been used for a qualifying activity, you can quite easily show that. And other thing I should have said, actually, sorry, that I forgot, is with the EIS1, your company has to have been trading for at least 4 months before you can actually submit that application. So if you are sort of starting from scratch, you might have a little wait before you can actually apply for the EIS. Next slide, please, Matt. Thank you. Finally, I just thought I'd give a quick overview in terms of the sorts of areas where I've got involved with EIS advising individuals and companies. So in the first instance, if you were thinking about EIS or even CDIS, which is a smaller relief for real startup companies, and you can do both CDIS and then move on to EIS, we would be able to have a look and see whether the qualification status would be met and whether there's any sort of sensitive issues around structuring there that need to be considered. Likewise, once you're a bit further along, we can assist with either the advance assurance or with the EIS1. And what can be quite helpful is that one thing that I find is that there always seems to be new issues that crop up in EIS that you've never seen before, and it's quite helpful having that relationship with the venture capital taxes team at HMRC just to ask questions on areas of uncertainty. Finally, I sit primarily in the private client team, and I often get involved with high net worth individuals who are thinking about investing and how that will impact on their broader tax affairs. And finally, a real key thing, I think if you are a company who has EIS status, it's really important to just remember that real key 3-year qualifying period. As I said, if any of those conditions are breached in that 3-year period, then your EIS status is withdrawn and your investors will lose their relief, so you could have some angry investors. So if you're thinking about doing things around restructuring or considering exit planning, then it's really important to seek advice on an ongoing basis. And also look into whether any of those other reliefs we've talked around today, the EMI, the R&D, etc., could also be relevant. Thank you.
Okay, so I didn't see any questions come through the chat, but not sure if there were any, or as we say, we're happy to people to post them now, or obviously, as we say, if you've got any questions that sort of bespoke to your business, very happy if you want to drop us an email afterwards. Just give people 1 minute, maybe. No. Okay. Well, as I say, if you do have anything, please do just get in touch. We're more than happy to help. Thanks, everybody.
Thanks, everyone.